Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. Today is August 11th, 2025. This is the 115th episode of Northbound Wealth Weekly Market Insights. Stocks rise on earnings despite tariffs. So let's go over the headlines. Stocks rebounded last week as investor optimism for a September rate adjustment, lower rate expectations, and strong second quarter corporate results overcame the rollout of fresh new tariffs. The S&P 500 index rose 2.43%, ending Friday's session at 6,389.45, bringing quarter-to-date gains to 3% and year-to-date growth to around 8.6%. The Nasdaq Composite Index gained 3.87%, closing the week at 21,450.20. The Dow Jones Industrial Average added 1.35%. The MSCI EAFE Index, which tracks developed overseas stock markets, increased 2.77%. Stocks pushed higher to start the week, with major averages gaining between 1.3% and 2%, their best day since May. Investors seemed more optimistic for a rate move after the weaker than expected jobs report. The odds of a 25 basis point rate cut by the Fed or the FOMC in September surged to 89% as of late Friday, from 80% a week ago and 61% a month earlier, according to the CME Fed Watch tool. Initial jobless claims rose to 226,000 in the week ended August 2nd, up from an upwardly revised 219,000 in the previous week, compared with expectations for 222,000 in a Bloomberg survey. Stocks rose again midweek after the White House confirmed a mega-cap tech company would invest $500 billion more in domestic manufacturing. News of additional tariffs on India was greeted with muted reaction from investors. The updated tariffs previously announced by the White House went into effect on Thursday. Markets initially rose in early trading, but then came under pressure as the day continued. But the S&P 500 and Dow rose again on Friday, ending the week with solid gains. The tech-heavy Nasdaq ended the week with a record close. Earnings helped fuel the rally in the information technology sector, with Palantir surging more than 21% this past week after second quarterly results topped estimates as sales in the U.S. increased. Apple shares jumped over 13% this week as the company announced plans to invest an additional $100 billion in the U.S. and bring more of its supply chain and advanced manufacturing to the country. That commitment, along with the launch of Apple's American Manufacturing Program, suggests that several of its products may be exempt from looming tariffs, Bank of America Securities said in a report. Tesla, also an index heavyweight along with Apple, was the second biggest gainer in consumer discretionary. The company awarded CEO Elon Musk 96 million new shares, it said in a filing. The shares will only vest if Musk stays in a top executive role through 2027 and come with a 5-year holding period except for taxes or purchase costs. Shares of the electronic vehicle manufacturer jumped 8.9% this week. Decliners included shares of Eli Lilly, which fell almost 18% this past week in the healthcare sector, though Eli Lilly raised its full-year outlook and reported stronger than expected second quarter results. Its shares were sold off as data from its investigational weight loss pill disappointed some investors. Okay, moving on. So Nasdaq Composite 1-year trailing number is up 32.08%. Year to date, it's up 10.42%. The S&P 500 Year to date's up 8.61. 1 year trailing's 23.56%. Dow Jones Industrial average 4.33%. 1 year trailing 15.41%. MSCI EFA year to date is up 20.51%, and 1 year trailing is up 21.11%. 10-year Treasury notes trading at 4.27. That's down from 4.42 just a month ago. Thank you, Y Charts, for that information. Let's talk about the economy watch. So services comprise 70% of the economy. So Wall Street closely monitors the Institute for Supply Management's Services Index. The ISM, for short, U.S. Services Index fell to 50.1 in July from 50.8 in June, compared with the 51.5 expected in a Bloomberg compiled survey. The 49.9 ISM print in May was the first sub 50 reading since June of 2024, and only the fifth in the 62 months since the pandemic recovery began in June of 2020, according to a note from Jefferies. A reading below 50 denotes contraction in the economy. So, news on Tuesday that growth in services came in below economist expectations was a bit of concern. However, investors seem to quickly look past the number and focus more on the 122 S&P 500 companies that reported earnings last week. This week is much lighter than last week as far as notable companies reporting earnings. Wednesday, we have Cisco. Thursday, Applied Materials, Deere, NetEase. And then let's go into the tax tip of the week. Did you know that the IRS has an app that makes checking some things off your tax to-do list easy? Using the app, and it's called the Using the IRS To Go app, as if it's like fast food or something. Check your refund status. Your refund status is available within 24 hours after the IRS receives your e-filed return or 4 weeks after receiving a paper return. Access IRS Free File. Free File is a tax prep software for taxpayers whose total adjusted gross income was $84,000 or less. Find payment options, including IRS Direct Pay, which allows you to pay your tax bills directly from your bank account, or get tax help. You can actually just use it as a tool to get tax help on your stuff. Stay up to date with updates from the IRS. That's another way to use the app. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional, and this tip was adapted from irs.gov. All right, stay tuned. We got a good show for you. Retirement today isn't an all or nothing. Instead of wondering when you can retire, ask how to reshape work so it brings more freedom and fulfillment. Think part-time consulting, board roles, or seasonal projects. For many, it's not about leaving work behind. It's about reclaiming time, energy, and purpose. The right financial strategy can give you the freedom to scale back without cutting back on lifestyle or goals. If you had an extra day off every other week or every week, how would you spend it? Or maybe you cut back on some hours. How would you spend it? That is our retirement tip of the week. All right, let's talk about behavioral finance 101. So education, school is in session and we're hitting our behavioral finance books, so they say. So sharpen your pencils, unfurl those notebooks, and let's explore some key concepts that can help shape financial decisions. Anchoring is when we rely on the first piece of information we encounter. It's called anchoring again. For example, after you see the price of an item, that information might influence your perception of that item even after the price has changed. Okay. Loss aversion. So loss aversion is when losses typically feel more painful than the pleasure of equivalent gains. Okay. When someone tends to overestimate their abilities or the accuracy of their predictions, they may fall prey to what they call overconfidence bias. Such confidence might lead to taking greater risks in financial decisions. Sometimes we already think we know an answer, but need information to back that up or justify it. When we search for, interpret, and remember information that confirms our preconceptions, we may ignore important data. So it's a bias that we have. Let's see, herd behavior occurs when someone mimics the actions of a larger group, often ignoring their own analysis. This can drive market trends based on collective emotions rather than facts. So that's it for this lesson as we review how we've done over the past 7 to 8 months and head into the second half of 2025. I hope you found this enjoyable. If you think it's educational and impactful, send it to a friend or tell them to follow the Northbound Wealth Podcast. Hey everyone, a recently signed executive order, not a law passed by Congress, has initiated a process that could pave the way for 401k plans to invest in private equity and other alternative assets, according to USA Today. Here's a breakdown of what's happening. Executive order signed on August 7th, 2025. President Trump signed executive order directing the Department of Labor and other federal agencies to examine and potentially revise regulations related to including alternative investments and defined contribution plans like 401ks. So an alternative asset, what is it? It's broadly defines alternative assets to encompass investments like private equity, private credit, real estate, actively managed investment vehicles holding digital assets like cryptocurrencies, commodities, and infrastructure development projects. And so what they're doing is they're going to re-examine DOL, or Department of Labor guidance, which the DOL is specifically instructed to revisit its existing guidance on the fiduciary responsibilities associated with offering asset allocation funds that include these alternative investments. The potential for new rules and safe harbors. The order suggests that the possibility of the DOL proposing new rules, regulations, or guidance, potentially including safe harbors to reduce uncertainty for fiduciaries considering these options. So, yeah, that's a big change and some important considerations. This is not an immediate change, okay? The executive order is a directive for agencies to act. It doesn't automatically mean private equity will appear in all 401ks tomorrow. Fiduciary responsibility remains. 401k plan managers still have a legal and ethical obligation to act in the best interest of investors, considering the risk of loss and potential gains of investments offered. Also, cost. Cost is a big deal with these alts. Private equity characteristics. Private equity and other alternative assets can offer diversification and potentially higher returns, but they typically involve higher risk, okay, are less liquid, meaning your money might be tied up for years. And oh, by the way, what happens if you retire and it's still in there? Can you move it? Can it roll over? There's so many things to address here. Less transparent. Yeah, alternatives are less transparent, less disclosure obligations there, and may involve higher fees, which a lot of times 2 and 20 on these private equity funds. Those costs would have to come down, I would think. And maybe those fund managers would be willing to take a lower cut if they're taking on risks of different things that they're having to do. But higher fees compared to traditional investments like stocks and bonds. There's debate and concern going on. The potential for these investments in 401ks has sparked debate, with some expressing concerns about whether these more complex and potentially higher risk investments are suitable for all individual investors in 401ks. In essence, the executive order signals a push to potentially expand investment choices within 401k plans, but the details and ultimate impact will depend on the actions taken by regulatory bodies like the DOL and the SEC in response to this directive. I happen to think I could go either way. If somebody has $1 million or more in a 401k, potentially, maybe those options should be expanded. But for the most part, I have the opinion I don't really like it because of the lack of transparency, higher costs, and then the illiquidity of it. all three of those combined, especially in retirement accounts, um, is a bit concerning to open that up to 401ks. Plus, it allows the private markets an exit strategy to a constant, consistent, long-term buyer at typically a higher price if it's going well, and then a significant discount, which might suck people in if it's not going well for those private owners to have constant liquidity going on. So I'm not really sure what to make of this, and except for I don't initially like it. There needs to be a lot of guardrails and regulation, which no one may like. I don't know. We sometimes there's a consumer protection element to this. Having some experience on how private equity or private funds, private credit can go south over the years, over the last couple decades. So I've seen the worst of the worst. Not to mention people committing fraud and doing that type of thing. So not exactly excited about it and having to advise people on this, but I do want to make everyone aware that uh, there was an executive order signed on August 7th, and we'll be looking at seeing how this plays out in the courts and with decision making. All right, stay tuned for the next segment, which is taking charge of your 401k. Taking charge of your 401k. Powerful information that could potentially save you thousands in taxes and fees. Tips to help you to get one step ahead in your retirement preparations, critical mistakes that cannot be corrected and how to avoid them. So, have you ever switched jobs? Research shows that the average American employee switches jobs more than 12 times by the time they turn the age of 56. Changing jobs can mean that many Americans have old 401k plans that may not be properly positioned to help them prepare for retirement. Every time you change jobs, you have some choices to make about your old 401k. Generally, there are four basic choices. Number one, staying put. If you are happy with your former employer's plan, you might consider just leaving your account behind. It's important to remember that you don't give up the right to move your account to your new employer's 401k or an IRA at any time. There may be restrictions on your money, however. For example, you may not be able to take a loan from the plan. Also, some employers may charge higher fees if you're not an active employee. All right, number two, you can roll over assets to your new employer's plan if the plan accepts transfers. So, taking your plan to your new job. So, this is one of the best arguments in favor of rolling over your old retirement plan is that it can help simplify your life. In our experience, investors tend to lose track of accounts that aren't right in front of them. Life gets busy, and failing to modify your investment strategies to keep up with your needs can undermine your long-term financial success, especially if you changed jobs 7 times. You got 7 401ks out there, all doing something different potentially. Putting your assets in one place can help ensure that your investments remain consistent with your financial goals. If you're considering this choice, remember to take a look at your new employer's plan before making the switch. It may be worse than the one before. So, got to look at that. First, make sure the new plan has investment choices that you're looking for. Second, check out the fees associated with the new plan. And third, see when you can join the plan. In some instances, you have to wait until the next enrollment period. All right, so number 3, seemingly a popular option, rolling 401k assets into an IRA. You can elect to roll over your traditional 401k plan into a traditional IRA. To initiate the rollover, you need to select an IRA provider and work with your 401k plan administrator. If the money is moved directly from your plan administrator to the IRA provider, no taxes are due on the assets that you move, and any new earnings accumulate tax deferred. In recent years, Roth 401k plans have been provided by more 401k plan administrators. Rolling over your Roth 401k is a similar process to rolling over a traditional 401k. If the money is moved directly, no taxes are due on the assets that you owe, and any new earnings accumulate tax deferred. Okay, and here's kind of a side note. Once you reach the age of 73, you must begin taking required minimum distributions from a traditional individual retirement account. In most circumstances, withdrawals from traditional IRAs are taxed as ordinary income, and if taken before the age of 59 and a half, may be subject to a 10% federal income tax penalty. To qualify for the tax-free and penalty-free withdrawal of earnings, Roth 401k distributions must meet a 5-year holding requirement and occur after the age of 59 and a half. So you can't really do a whole lot with this stuff until you're after the age of 59 and a half. Tax-free and penalty-free withdrawals can also be taken under certain other circumstances, such as the owner's death. Employer matching is pre-tax and not distributed tax-free during retirement. FYI on that one. A lot of people overlook that one. All right, number 4. This one people run into and kind of seemingly accidentally do from time to time. Another choice is called cashing out. So this other choice is to liquidate your old 401k plan and receive the money directly. It's called constructive receipt. While it can be tempting to see your savings as a quick source of cash, cashing out may result in penalties and taxes. Your 401k plan administrator will withhold 20% of your current account balance to repay the tax you'll owe. Remember, your 401k was funded with pre-tax dollars. Your account will pay federal, state, and local taxes. Also, the IRS will consider your payment an early distribution and may assess a 10% early withdrawal penalty. So 10%, boom, gone, penalty. That kind of stinks. So, why work with a professional? One of the benefits of working with a firm like ours here at Northbound Wealth is the comfort of knowing that you have a team of professionals continually monitoring your investments and keeping you on track. Investments are just one piece of your overall financial picture. As professionals, we take every aspect of your financial life into consideration when building customized strategies for your retirement. All right. So, what should you do next? Whether you're leaving your job to pursue other opportunities or on the wrong side of an economic downturn, the transition can be a stressful experience. Discussing your situation with a financial professional can help you relax and explore all your choices. Make the best choice for you. You can always reach out to us for a complimentary review session. We'll take a look at your current financial situation, present you with strategies that make the most sense for you in your financial future. And we can go over how to negotiate a settlement or a compensation package, what to consider if you own a company stock. So RSUs and those are restricted stock units, vested shares, non-vesting, all that kind of stuff. The dangers of holding too much company stock, like over-concentration risk and things like that. How to prevent job losses or money emergencies from derailing your financial future, and just to simplify your life. I mean, recently I had a client that had 7 401ks out there, 7. And we got it all dialed in a month. We were able to consolidate those accounts and get them working for that client. And that was pretty cool. Just to be able to look at one portfolio and surprising how it all worked out. We developed this particular podcast session format after helping hundreds of clients manage their finances during critical life transitions over the past 20 years. And thank you, BLS.gov 2025, FINRA.org 2025, and the IRS.gov 2025 source data for this particular release of the podcast. All right, stay tuned for the next segment. Hey everyone, it is back to school month for most people around the country. Savvy budgeting tips to help keep kids' costs in check, because man, they seem to be going up every year between all the supplies that you have to acquire for each kid and then deliver to the school and that type of thing. Here's some good tips. Look ahead, try to prioritize your essentials early to find deals. So oftentimes you can go to Amazon or other places, pick up some discounted items or maybe some kits that offer like a combination discount, that type of thing, like a bundle. Swap and share. Join a book or school-sponsored uniform swap to help save big money. Uniform costs can really drive up the expenses when it comes to kids. Home lunches, homemade lunches can help save over the school year. So keep that in mind. Bundle and save. Keep an eye out for discounted and bundled school items. Join a carpool, save on gas, and help your kids make friends. There you go. That is your back to school tips. Also, August is National Make a Will Month. So if you haven't made a will, you don't have your healthcare directives in place, you guys need to do that, especially if you have children or beneficiaries that are going to inherit your wealth. You need to get with an estate planning attorney and draft up your wills, draft up your legal documents in case something were to happen to you. All right, so focus on that this August.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.